So, welcome to the channel, guys. I'm thrilled to be joined today by Jay Hatfield, the founder, CEO, and CIO of InfraCap Capital Advisors. And Jay is a true veteran of the markets with a career spanning top-tier firms like Morgan Stanley and the legendary SAC Capital. He's brought the institutional hedge fund expertise to the ETF world, and most recently through the launch of the PFFI Infrastructure Capital Preferred Income ETF here in Europe via Han ETF platform. Jay, it's great to have you here. If you don't mind, just quickly introduce yourself to the community and a little bit around your business.
Fantastic. It's great to be on Cashflow Mindset. So my background, as you mentioned, I've been on Wall Street for 37 short years doing investment banking, about half of that time, investment management, the other. I founded this company 17 years ago. And I'm also a CPA, MBA from Wharton, undergrad, monetary economics. We have great macro research. If people care about the US economy, it's on the US economy, but sometimes people do because we have a big capital market. And what our firm does, Infrastructure Capital, I came from the utility investment banking side at Morgan Stanley. So we like, not that we don't do tech and really everything in the US, but we do, particularly for preferreds, like asset intensive companies. So we do have a lot of, if you look at PFFI, we have a lot of utilities, we have a lot of real estate and other companies, pipelines that have old economy assets that are great collateral, can be sold, produce good cash flow, usually a lot of common dividends. The rating agencies tend to underrate those companies. And so that's why we really launched, and all of our funds in the US, and we are expecting to expand pretty quickly in Europe. We think it's a great market. I'm headed over there in a few weeks, and I speak 3 words of German, so that could be helpful. I studied for 5 years. Every year got me 1 word in German. So I'm looking forward to unveiling my German in Germany, but I do speak English. So looking forward to that trip, likely to launch 2 or 3 other funds pretty quickly. So we think it's a great opportunity. And so that's our firm, all income focused funds. We do think and they're all monthly pay, going to be all active. So we do believe that income should be a component of everybody's portfolio. Obviously, when you get older, the more income, the better, because then you don't have to worry about, if you need the income, you don't have to worry about fluctuations in the market.
Yeah, and I think the difference between your type of funds and the typical income funds we've seen recently, the high yield ones from the likes of YieldMax in the US and income shares in the UK, I guess you're looking for more stability, so there isn't this erratic payments and NAV erosion and all those kinds of things. So what we will talk about a little bit later on, but I think one of the good things about the preferred shares things is the yields will be typically fairly stable-ish, obviously depending on interest rates and things like that, but in terms of the market. So I think that will be good for the community to understand a little bit better, because again, a lot of them have been burnt by potentially going all in and not really understanding the strategies and stuff and learning along the way. So I think twice bitten type situation where people are a little bit shy now for obvious reasons, but obviously getting this educational content out there is part of what I do on this channel, hence why I was keen to bring you on to explain directly from your perspective how that works. And you've partnered with Han ETF. Explain to me what was the rationale of picking Han ETF, because I know there are other white labelers also in Europe and the UK.
Well, they actually approached us to potentially advise on their pipeline ETF. I founded a pipeline company in the US. I was we call them MLPs, but pipeline investment banker. Utilities and pipelines are very closely related because actually some of them are regulated in the US. And so that's where the dialogue opened, and we're still in dialogue on that. But then we said, well, look, there's this fantastic asset class. We have the #1 performing fund in the US over the last 8 years in all of fixed income, which is a big distinction we can talk about later, fixed income versus equity income. Sure. So they quickly agreed that's a great opportunity. So started with pipelines, but then we focused on our favorite asset class, which is preferred stocks, which we can explain why we love them. And they agreed, and so we launched it, and we're super excited about the potential growth and also looking at some other ETFs, mostly income focused.
Yeah, it launched around, I think, September, middle of September. Net asset for the fund is, according to the website, 4.5 million at the time of recording today. So it's had some good growth, 80 basis points expense ratio. I want to touch on something else you just raised, which is the investment style, which is active, right? And I want you to explain to the community the difference between kind of active management and what does that mean from your perspective versus obviously just having a very set and forget passive fund.
Well, I think the critical distinction of this video should be the difference between fixed income and equity income, because they're often confused in investors' mind. So if you want something that's safe and will support your retirement income, I would always counsel having a good portion of fixed income. So for instance, our US fund, PFFA, is more than half of my IRA. So a really great base for your retirement. But the distinction is important also with active management versus passive. So passive management can be even superior for equities because in effect, most of them are cap weighted. So the bigger companies become, the more they buy. And that can be a fantastic strategy because at least in the short run, momentum factors work really well. So if gold's going up, you buy more gold, keep buying it until it reverses. I mean, we don't really do that, but it's a perfectly reasonable strategy. But with fixed income, it's the opposite. When they're callable par, so they have a limited value. So Nvidia or big US tech companies can go to infinity. Sometimes they become massively overvalued. So it's dumb to sell them. But if you have a bond or a preferred stock, they're always callable at par or mature at par. And so you need to, when they trade above par, you have to sell them or else you're doing something uneconomic.
Yeah.
So you have to, that's called the call risk. So we manage that. Also with equities, they're going to be a default, but it's trivial because you can have like these gigantic winners that offset any defaults. But when you're capped at par, you want to avoid having some big loser. And so we manage default risk. And then you also have interest rate risk, which you don't have with equities. And so we're managing those three risks. And that's really critical. And you can see that in the returns of our US fund, where we've done double the big index fund. We're still trying to get the returns to you, but I know I just looked them up on Bloomberg. I know we've also beaten the passive index by a lot since we launched the fund. And that's not surprising because it's like playing soccer and there's no opposing team.
Right.
So you kick the ball down and you kick a goal and then you do it again. So it's not really that surprising. They're just running these rules. And then this is a little bit subtle, but we take advantage of the index funds as well. They rebalance and they are cap weighted. So they're buying the preferred stocks that ran up and selling the ones that are down a little bit. And as long as they're good credits, we'll do the opposite. So we'll sell them our overvalued securities and buy our undervalued. And we also do new issue. So a new stock comes out, we can buy it. The index funds can't. They bid it up. We sell some of what we bought, generate capital gains. So really the deck is heavily stacked in our favor. And we think we do great work. We do a ton of research on every company. And by the way, we're client service oriented, mostly by managing the portfolios, to be fair, but we do videos like this. We take questions on our website. So we actually love taking questions from you and your subscribers because it makes us sharper. We start to understand what you're worried about. Sometimes we'll change what we're doing. So you can contact me directly. I'll respond or some of our other people, but so we're available to answer your questions, but we have models on every single one of these companies. We talk to them all the time. In the US, we're one of probably their biggest holder. So we can get to them immediately. So the PFFI is a relatively small fund, but has very similar holdings to the $2.2 billion fund we have in the
Right.
US. So it's not like we're calling them, say, well, you have $2 million of preferred. So no, it's like we're the largest holder of your preferred. So you really should return our phone call. So, and that's important because sometimes, I mean, obviously, mostly we're looking at public info, but sometimes there's subtleties like what are they going to do with the preferreds or just something about their disclosure that's not clear. And so we'll get a little bit of flavor for that. So we're not just spraying money out there. We have very tight research on all the companies. And for instance, with REITs in the US, real estate investment trusts,
Yeah.
they disclose every building. And so we'll model every building. And
Oh,
a lot
wow.
of them don't have mortgages on them. So actually great credit. So in effect, the preferred's collateral, they're not real collateral, like it's not legal collateral, but you
Yeah.
get first call on unlevered buildings or pipelines, same thing, first call on unlevered super long-term pipelines or utilities are the best. And the rating agency, the other reason active management is important, the rating agencies in the US make a lot of what we think are mistakes. They underrate preferreds. So preferreds are a great asset class. The default rate's really low, but the yields are high. So
Yeah.
they're misrated. And then we also think the rating agencies misrate asset intensive businesses that pay dividends because the rating agencies say, oh, well, you're paying too much money out in common dividends. But our attitude is, well, you can always stop paying common dividends and
You
then
could.
pay
Yeah.
the preferreds. And the reason you're paying dividends, like with utilities, is you have this great stable business. It's not like having
Stable cash
NVIDIA,
flow, revenue. Yeah.
and you're not going to expand infinitely fast. So they're penalizing them for something that's actually great for the credit. So there's the rating agencies also in the US create opportunities for us as well. And that's why we've been able to consistently outperform the passive indexes.
Interesting. And yeah, I released a video on this fund actually, and one of the things that's quite unusual for European investors is to understand where preferred appears in the stack. You got debt which a company tries to clear, and then whatever cash is left over, they'll predominantly pay the preferred shareholders next, and then they'll give it to common shareholders. So I think a lot of people view this as how stable is the income, right? We've had some recent turmoil, we've had financial crashes, we've had a pandemic, and a lot of people have seen cuts, right? It's interesting to understand how would a business prioritize preferred stocks, and particularly you talked about retirement in the UK. You mentioned an IRA. We have a SIP, is what we call it, a private SIP, private pension, which your fund is allowed in certainly in the UK. So I think that's an important point to leverage as well, right? Where the priorities of preferred shares.
One thing that I didn't mention, which is absolutely critical, is that every preferred that we own is an obligation of a public company. So these are listed companies. We have very strict, and they're almost all US companies, not all. I guess we have a few more European companies, but similar in Europe. So we have very strict disclosures and tons of liability for management if they violate those disclosures. As distinct, I don't think it's as big in Europe as it is in the US, but we have these private credit funds, and they're the opposite, where they're private companies, there can be frauds. The companies can't issue common. And so to directly answer your question, though, so during the pandemic is a great example. There were, as you were indicating, tons of common dividend cuts.
Yes.
But almost no preferred dividend. Well, you can't cut the dividend, you can not pay it.
Yeah.
There's something called cumulative preferred, which is what we mostly have. So even when you don't pay a preferred dividend, you still owe it. And what you'll find is, and I know this from being an investment banker, companies are loath to not pay their common dividends because then it looks like they're bad credit. And that does matter for public companies. First of all, they promise their boards, so they have public boards and they can be fired, that they're going to maintain these credit ratings.
Of course.
But also, almost every business has counterparties. So particularly these big energy companies and utilities, so they're constantly selling energy and transporting energy for counterparties. Well, they don't want bad credits. So they don't want to look and say, oh my gosh, you're claiming it's a good credit, but you're in arrears on our preferred. That's terrible. But there was tons of common cuts, but no preferred, very, very few preferred cuts. And then when there was a couple suspensions, they literally intra-quarter reinstated the preferred dividend because they just didn't want
Oh,
that
interesting.
stigma. Another example, I founded an energy company that did get very disadvantaged by the pandemic. Oil prices went to negative $30 in
Yeah.
the US, but they were able to refinance their debt. They had suspended their preferred dividends for like even, I think, 3 years. So they owed like $6, $7, $8, and they paid them all back. So this
Yeah.
cumulative feature, because the same thing, they wanted to accomplish certain things like pay common dividends and buy back shares. So there was a huge incentive for them to pay that back. So it's a huge advantage over equity income to have this seniority, but only, to be fair, with good credits,
Yeah.
big public companies who care about their credit. Like I wouldn't buy a private preferred. They sort of don't. There's very few of those, but it's a huge distinction. Like the default rates on preferreds, Moody's data over 30 years is 0.6, but for high yield, public high yield bonds, it's 3. Private credit's got to be a lot higher than that.
Yeah.
So you get good, similar yields to high yield bonds, but way lower default rates. We never had any significant defaults because we don't like marginal credits. So it's fundamentally a great asset class, but one, because of those anomalies about the rating agencies and public versus private companies, but one that should be actively managed. I mean, individuals can do it themselves, but there's diseconomies of scale. We're managing billions of preferreds even alone. And we have Bloomberg's and data feeds, and we can
Yeah.
calculate yield to call. So for instance, I don't manage my own preferreds for my IRA or my personal account. I outsource it to our firm because I don't want 180 preferreds
Yeah.
in my IRA. It's just a mess. And it's not even really worth it. Same thing for me, even diseconomies of scale. Like, do I really want to worry that I should sell the preferred in my IRA that's trading at 25.50 that I bought at 25 and is callable at 25? I mean, if it's like 1,000 shares, is that really worth my time to log on and slowly sell it? But, if we're managing, and we are, because they're roughly the same preferred, billions of dollars, then we're going to be all over those calcs and selling those preferreds and taking small profits and then recycling them. So it's a fine asset class for individuals to manage themselves, but it takes a lot of work and there's
Yeah.
diseconomies of scale. So even like large family offices in the US, they'll run their own equities, but they'll outsource the preferred stuff because it's just
Interesting.
not worth their time to go micromanage these small differences. Like they'll buy NVIDIA. They're like, well, why do I want you to buy NVIDIA for me? Because we know NVIDIA, but if you want to buy GNL preferred D, like we don't care about GNL preferred D. You go worry about that. But so it is a
Interesting.
great asset class, first of all, no matter how you access it. So I would recommend it. And then we do think our funds are obviously a superior way to do that. But the fundamental point is a great asset class, particularly if you're looking for conservative income, but really good total returns. Like our US fund has done 8 over the last 8 years since we launched it. And you might say, oh, that's not that great, and it yields over 9. But that was pretty much a horrible time to own fixed income. You had the pandemic,
Yeah.
Fed was super loose, Fed was super tight, Fed hasn't even loosened yet.
Yeah.
So when you have
No.
these higher coupons, it tends to protect against volatility because you're just getting so much income. The price can move around, and you're still like, well, I got the income. And you can even, if you have the cash, reinvest at a lower price, take advantage of the volatility, knowing that since you're senior to common, it's very likely that you'll continue to get the income.
Yeah, I've been looking at obviously when I released the video, there was no data. I released it, I think, a week after it came out. And I'm just looking, the yield is around 8%. The payments, the distributions per share have fixed 1, 2, 3, 4, 5 payments now. So almost 6 months now. Is that distribution per share deliberate? Are you holding some of it back in the NAV, or how are you doing the distributions and
So
managing the
we
distributions?
So in the US, there's an calculation of SEC yield. Obviously, you probably don't do that in Europe,
No, we don't.
but you can see it on our US funds. So we calculate the yield of the underlying securities, and that's what we pay out. And we have a little bit of extra right now of income coming in, but it's not like the call writing funds where they basically have no income and they're just manufacturing the income by writing calls, which can hurt their returns. We're just holding these securities. We only sell them really when we have a gain above par, so holding them forever-ish if warranted, and then collecting the income and then distributing it. So the income is fully covered by cash flow. So unless we have a problem, which is what we're spending all our time trying to avoid, where there's a big credit issue and we don't get that payment.
Yeah.
Even if there's a small problem, we are booking profits on new issue on these kind of random movements, partially driven by these inefficient index funds above par. So we're selling. So even if we had a problem, we haven't had a significant one, but we still would have potential to take gains and offset any losses we had if we did make a big credit mistake. But we haven't before. Just we're doing a ton of work, but there aren't a lot of credit problems because these are good, large cap, public companies in pretty boring industries. Like I can't remember any tech companies.
Yeah, I think I covered the listing on my video, and actually just going on to Han ETF's website. And again, not sure how up to date it is and how often it changes, but there are things like Bank of California, I could see is quite a heavy weighting at around 3%. And then quite rightly, there's some energy companies. There's a lot of companies in here that, to be honest, European investors wouldn't even recognize. If some of your US investors, of course, would. But there are some names in there that I'm sure people may have heard of. In AGNC, for example, was one that people used to invest in Europe, mortgage REIT, because it's quite popular. Enbridge, I'm sure a lot of people have heard of. So there are some names in there that people may recognize. I noticed there's actually 73. I didn't realize it was that many. So it is quite a lot to manage.
And that is important because there's no infinite returns, right? So you can't have this gigantic idea like Enbridge is going to go to infinity. It's not. It's going to be at 25. Yeah. So you want to be diversified so that if you do make a mistake, it's relatively small. We're hoping not to make a mistake, of course.
Yeah, one of the things I did call out on my video was actually the weightings, the sector weightings were quite interesting. And I want to ask this question. I don't know whether it's because the preferred shares are the stable preferred shares, I should say, are more available in this market, but I can see almost 77% of the portfolio is weighted to financials, and the rest are all quite small. They're under 10% after that. I don't know whether that's an error on the website, or is that technically true? Is it?
Well, it's a little bit of a problem, and I'm glad you pointed it out because we probably should fix it. But financials, in our opinion, is too broadly defined. So, but financials, by the way, are huge issuers of U.S. preferreds, pure financial, what I would call pure financials. But I'm 99% certain, including REITs, so real estate investment trusts as financials, and mortgage REITs as financials.
Okay,
and
so
then the rest
like
of them,
AGNC will be in
so
that.
then the rest of them would be what I would call financials, which would be banks and private equity firms. But so this is again another great example. Like we like to talk to podcasters and clients because I think that's a little bit misleading. Like if you were looking for 70% financials, you might be disappointed and say, well, wait, is a REIT really a financial? Isn't it like real estate company? Is that a financial? I would say not. They just hold real estate. So, but to be fair, if you include all those broad financials, they're the major issuers of preferred, because the reason that companies issue preferreds is they're in an asset-intensive business where the cost of capital matters a lot. So because you're investing in pretty conservative assets, for pure financials, that might be mortgages or pretty conservative loans. For REITs, it's buildings, so those have good returns, but not fantastic. So they're almost all the issuers. So like a tech company, they're going to either crush it or not, or get crushed. It doesn't really matter if their cost of capital is a little bit lower because they issued some preferreds. So those are the dominant issuers. But that's good because they're investing in very conservative assets, and that's why they need to get lower cost of capital so that their return on equity is better.
Makes sense. And for people that are less familiar with preferred shares, maybe they're more familiar with bonds. Similarly, you're seeing percentage numbers associated against each position and a date. Do you want to explain the purpose of that? So, you've got one that says diversified healthcare 6.25%, 020146. So, do you want to help people understand the data that they're looking at? Sometimes people
Right.
look at these spreadsheets and they go, what's that
Well,
about?
so that's a great example. We do have 20% that are technically bonds. It's not all preferreds. They're listed bonds, though. So those are listed bonds. And listed
Okay.
is important because it's more efficient to trade them. And that's why I said individuals could manage their own portfolio, because if you can get to US listed securities, like actually I have a hard time buying European securities through my accounts,
Yeah.
but if you can, then you can transact on an exchange. You do not, it's very difficult for individuals to trade over the counter in the US. And so everything
Okay.
we have is listed, but that happens to be technically a bond, and so it has a maturity date. A lot of preferreds do not. They are callable at par, but they don't have a maturity date. So to the extent there's a date there, it's a bond. And so it actually is a little bit better credit if there's a problem. And so that's good, but at least in the US, you get taxed as a bond, so that's not great. But so we're 80% preferred, that's the rule to say your preferred fund, but we do have some, but they're not just like random bonds, high yield bonds or private credit bonds. They're listed bonds, often of times from companies that also issue preferreds.
Yeah, and you raised a good point with tax. You're fortunate we can put your fund in a tax wrapper, but obviously we still have the withholding tax that comes across from the US. So we do fall foul of that 15%, 30%, depending on whether you sign a W8BN. And sometimes the fund absorbs some of that as well due to the way the pass-through works. In terms of preferreds, is there a class situation like we have with Class A shares, Class B shares? Is there a very similar thing with preferreds, or is it a company will just issue the preferreds?
So there's most preferreds, because it's part of their strategy. They'll have an A, B, C, D, E, F, G, or whatever it is. They're
Yeah.
all pari passu, but depending on the market conditions at the time, they'll have higher or lower coupons. And then after 5 years, they are callable, and they also go fixed to floating. So,
Okay.
so like you do have to analyze every issue, and that's why. And if they're trading above par, you need to calculate something called yield to call, to take into consideration that in 2 or 3 years they're likely to be called, or even right away. So
Yeah.
that's why I said that it's perfectly reasonable for somebody to run their own portfolio, but it's highly complex. So you could look on public data sources. In the US we have Barron's, but wherever say, oh, well, this preferred D looks better than preferred C. But then you realize one's callable sooner and one's above par and the
Yeah.
other's below par. And all of a sudden you either need a Bloomberg, which is expensive, or a lot of spreadsheets, and it's easier to pick stocks than it is to pick preferreds.
Makes sense. And one of the things we haven't really talked about is the availability of the funds. So I can see that it's on the London Stock Exchange in two currencies, dollars and sterling. You've also got availability on the Extra, and you've also listing on which is euros, obviously, and then the Borsa Italia, which is again euros, but it's accessible to quite a wide range of European countries, which is good to see. You mentioned some more listings coming. Is the idea to again list in similar locations for the newer funds, or are you looking to broaden that out a little bit?
Probably similar locations. I mean, we do look on ETFs to come up with that strategy.
Yeah.
But we do want economies of scale. Like I mentioned, I'm going to Europe. And I guess that sounds trivial, but it's not that trivial to me. And I used to be an investment banker, and I don't really want to be an investment banker anymore. So it looks a lot like a roadshow.
Yeah.
But so we want to have listings in the same countries so that there's economies of scale. So if I go meet with Italian investors, we can talk about 3 ETFs, not one. So
Yeah,
I think
of
we'd
course.
probably follow the same pattern, but we'd look to on ETFs because we have to be a little bit, we do every sector in the US, but we don't do every company in the world. So we're a
Yeah.
little bit US focused. So we look to they're a great partner because they have tremendous expertise in the European markets.
Yeah, because you talked about this, right? The country weightings, I think, were, according to the website, 97% US, and then about 1% Canada, and then
Mhm.
obviously cash within the fund. So is there any plans to expand out the US, or do you feel that's your comfort area in terms of knowledge and understanding what the Fed's likely to do next?
Yeah, no doubt that, we find the disclosure in the US to be fantastic and follow, US Fed policy. Not that we don't know anything about the world, but we follow every sector. And
Yeah,
so we have to be a little bit focused. So the chances that, I mean, we can have like benchmark, like Banco Santander or something that we all
yeah,
know, and they do business in the US. Or like we've owned British Petroleum and Shell, but they're not
yeah.
really European or US companies. They're global
They're
energy
global brands.
companies.
Yeah,
But we're not going to go in and find like maybe why Deutsche Bank, but some regional bank. They're just
sure.
there's a huge advantage in being focused. And we do even do tech stocks in the US. So we do probably have more research on the old economy, but we don't want to go cover SAP when we're trying to focus on the US companies.
No, that makes sense. And we've touched upon this through the interview. And you've mentioned your Roth IRA, your IRA, which equivalent for us in UK, which is our SIP or private pensions. When you released this fund, who did you see is the target audience for you, and what kind of portfolio did you see this fund fitting for? Like, what was the driver for releasing this fund first out of probably other funds that you've got out there? And I'm sure there was some discussion, obviously, with Hand ETF on it, but from your personal perspective.
Well, what we found, and we suspect this to be true, because we have always loved preferreds. Really, where we got our capital is buying not distressed, but depressed preferreds during the financial crisis. So, in other words, the companies were all totally fine. So we didn't do pure financials like the banks,
Yeah,
but REITs, because REITs would say, oh, well, their preferreds are at 5, and keep in mind they're callable 25. They're yielding 30%, but we can go through and look at all the buildings and see they're massively covered by real estate assets. So a fantastic asset class. So what we found in the US is everybody loves PFFA. It's A in the US and I in Europe.
okay.
And so it's just an easy sell. Like people say, oh, you can get the yield's a little bit higher in the US because we run a little bit of leverage. Oh, you can get a 9 yield. It's a top performing fund. It's senior to common. It's pretty low volatility. So we just start with that, and then we sell them our other funds because we have 3 equity funds and a bond fund too. So it sells itself. And that's what we wanted to start with in Europe, but just some kind of a no-brainer, like a great asset class, great yields, great returns if you actively manage it, or likely great returns. And and it sells well to retail advisors like it because it's stability and income.
Yeah.
And even we find we call them family offices here, but wealthy individuals and families, they'll
Yeah.
like it too, because like I said, they might want to go buy their own equities. Like, so they might have research and management in their family offices, but they just don't want to bother with the 200 issues or 70 in the case. We have, well, issuers, I think it's 70. In the US, we have more issues because of those ABCD things, but they just don't want to
Yeah.
deal with that, even though they have research departments and some economies of scale. So we think you'll get the same type of reach when we go meet with these smaller institutions like family offices, definitely advisors. And then it's a little bit more challenging in Europe to get to the retail investors. But when they find
Yeah.
out about it, they say, oh, we have monthly income, senior to common, great public companies, low default rates. What's not to like? So we think,
Yeah, it's
and we've seen that
interesting.
a little bit because I haven't even been to Europe, and we get pretty decent volumes on our funds. and it's harder to advertise in Europe. So we
Yeah.
consider it to be a great reception. And as we continue to ramp up our marketing efforts, we think that it's going to be a huge market for us.
Yeah, the FCA are quite heavy in the UK for sure. And Europe, similarly, there are UCITS regulations, as you're aware of, that make it quite challenging in terms of how you diversify the portfolio and things like that. You mentioned volatility. I think this is a really good point. You probably don't know off the top of your head, but how does the beta look for the fund? I mean, is it compared to general market, would you say?
Well, so with PFFA, I can look this up because I actually have it here on my Bloomberg.
Yeah,
But
and it'll probably be very similar
I'll look it
for
up.
the European.
I can sort of do two things at once, but not really. But I would use, so this is just purely being spit off of Bloomberg.
Yeah, that's fine.
And so it's usually pretty accurate, but that's where I'm getting the data. The raw beta is 0.355. So it's
Okay.
30% of the market. Now, just to be fair, like the recent sell-off we had in the US was mostly tech driven.
Yes,
So
it was.
preferreds, and we have zero tech in our preferred funds. And so, and there's a counter rotation going on in the US where people are buying boring companies like preferreds and banks and regular banks, regional banks. So it's probably a little bit lower than normal. Like if there's just a massive across the board sell off, I would use 0.5 as the beta. And then there's just to be, so everybody's with this like full disclosure point. If there's just a liquidation with a capital L, like pandemic, great financial crisis,
Yeah,
extinction event, comet hits the US like a Greenland extinction event, then the betas will rise towards one because retail investors or every investor kind of flushes everything they own.
correct.
And
Correct.
so I just don't want to like say if there's
No,
Armageddon.
I think it's good for the community to understand volatility because obviously a lot of my community are into income funds and particularly the high yield funds where obviously the volatility is what they're harvesting in a way. So it's important for people to understand this.
There's one
I
other
guess
piece
just
of data that I'll just throw out there. Sorry to interrupt, but
no, it's
I just noticed this recently because I have an Interactive Brokers is
yeah,
our prime broker, and one of the listings I have is just the pure volatility, not the beta. And I
yeah,
was surprised. I said, "Oh, the volatility of PFFA is 5%." And like the
okay,
normal stock's 20 and like
yeah,
MicroStrategy's 40 and Nvidia's
yeah,
45. And so at least in this market, like it is low. Like it basically is watching grass grow,
yeah,
except it pays you
yeah,
9%.
yeah,
But just the only warning is in Armageddon, like everything that trades in the stock exchange tends to trade to one. I mean, that's an
yeah.
opportunity. If you have cash, you buy it. You should
Correct,
buy it.
correct. Yeah,
Historically,
buy the dip. Yeah,
yeah, well, because that's really why we have capitals. We bought it. I mean, it was a crazy dip because they were at 5 and they went to 25. But like our main private fund was up 250% in '09 because it was just pure irrationality, like 100% irrational. Like these were great securities, senior to common. People are dumping them for no reason. Now, I don't think that's going to happen anytime soon because I think we've gotten a little bit smarter about maintaining the integrity of the financial system. I'm not sure we got smarter about dealing with pandemics. Maybe actually, hopefully we have there too. But barring that, this is going to be a boring asset class. It's a get rich slowly scheme.
yeah.
And you're protected, even if people do freak out a little bit, protected because you're senior to common. But during the pandemic, yeah, people sold these things way off, but the cash flow remained stable.
Remain stable. Yeah, I love Warren Buffett's quote about stock market being a voting machine, but long term being a weighing machine. It sticks with me that if you panic sell, that's where people are making money off you rather than you making money off the market. So I think that's quite important.
Notice too
I've taken
that quick interjection. Buffett
no, it's okay.
typically will invest in preferreds. So Oxy, because it gives them a
Yeah,
little bit of margin of error. So he's
yeah,
also on that page of doesn't hurt to be senior to common.
yeah. Okay, we've taken a lot of your time up, Jay, but I guess something you can ask back to the community. Obviously, this will be posted on YouTube and the comments are normally quite active. So have you got any questions to the community, I guess, around the fund or anything around that you'd like to get back?
Well, I mean, I think you've started this, but I'm a CPA, but unfortunately in the US, so I need to understand your taxation better. So
Yeah.
that'll be a to-do list item, at least when I'm in Europe. I'll try to understand that better. And because even, I mean, believe me, if you want one complicated tax area, it's like in the US, it's international tax. That's like the most
Yeah.
complicated possible area. But I should understand the basics in Europe. So if anybody has any primers or wants to give me some hints on that, I think
Yeah.
that's an area where we need to learn. But otherwise, just like I said, whether it's comment or question, we are not arrogant people. Like like somebody asked me something pretty obscure about the Federal Reserve, and I said, well, I think this is the answer, but I'm going to go and figure out the exact answer. Now I know, so I'm better for the question. So we love the questions. You can ask them through your service, but we'll take them directly on our website. You can
Great.
call us, we'll answer the phone. So we're different than a lot of big, gigantic, we're pretty big, but money managers who like you can't get anybody. We're committed to answering all of our clients' questions.
That's
So,
great.
and we benefit from them. So more questions, the better, or comments for that matter.
Great. Thanks, Jay. Appreciate your time. And yeah, and by the way, for the community, Jay, as he's mentioned, he's over in Europe. He's going to be presenting, and he's kindly agreed to come back on and actually share some of that information that he's put together for those presentations. So don't be surprised if we do a follow-up. And if there are any questions in the comments, I'll make note of them or put them in the Discord. I'll take them from the Discord. And if I can get them direct from Jay while he's over, I'm hoping to meet him as well, then I will do. Otherwise, we'll do it in the follow-up video. All right. Thanks again, Jay, for your time. Really appreciate all the effort that you put into and the time that you put towards this.
Thanks for having me on. Great questions. Appreciate it.